So the dividend discount model kind of helps us understand how markets work, right? When you look at the dividend discount model, for example, just think of the Gordon growth model as in the constant growth model. And can you try to explain during, for example, COVID, what would have happened? How would markets react? How would market prices react? There was a sharp decline, but can you explain the reason for that sharp decline using the dividend discount model? Okay. Then anything else? So your future dividends, you're expecting to come down. And the growth in future dividends also you're expecting to come down, right? Is that it? Lower. Yes. Which impacts your price. So your D1 comes down, which means the numerator coming down brings your P down. Plus the growth rate comes down. So the growth rate coming down impacts the R minus G, because then the R minus G increases, right? So then what happens? The gap increases. So R minus G goes up. So therefore, when your denominator goes up, what happens? Price again comes down. Is that the only thing, though? Is there any other impact that you can think of? Any other further explanation? What about R? Are there any impacts to R? Absolutely. Is the riskiness increased? So people's required rate of returns increase, which again increases the denominator, which again brings prices down. So the dividend discount model is a very easy way to kind of understand how the stock market would be impacted for different events. Like, for example, 9/11 in the US, right? When the two planes crashed to the World Trade Center. And when Enron, the seventh largest company in the US, crashed in 2001, stock markets crashed, right? Enron went bankrupt, stock markets crashed. 9/11 happened, stock markets crashed. Tsunami happened in Sri Lanka, stock markets crashed. COVID happened across the globe, stock markets crashed initially. But why does that happen? That happens because, one, your expectation of future dividends come down with the expectation of growth coming down. Like, for example, when something like the tsunami happened, I mean, that impacted the entire economy, right? And entire economy being impacted means, again, you're expecting that future growth prospects would come down. 9/11, same thing. Enron bankruptcy, same thing. And your the return that you want for the risk that you're taking goes up. You want a higher return for investing in a market that you're not sure of. Now the market is more volatile. So with all of these happening, you can see your numerator comes down. In your denominator, your risk levels go up. So your required rate of return goes up. But your G, expected growth rates, come down. So because of this, you can subsequently see this contributes to the market fall. So like this, you can use it's a quick and dirty calculation in terms of looking at the dividend discount model to figure out how certain things impact market movements. Also, when you look at the dividend discount model or any model, actually, I I put this slide here, but this could be right at the end as well. When you look at any model and you figure out what is the price of your company based on the present value of your future cash flows, one thing that we should understand is that the price that I'm willing to pay depends on the discount rate that I use, right? It depends on my required rate of return, which technically, in theory, should be the same across the board, but it is not, right? Different people have different resistances to investing in the market, different assumptions about the market, sometimes not enough information about certain things happening, and therefore they underestimate risk, right? So, because of the way that they look at risk and they estimate risk, the discount rate that I use will be different. Remember, in the simple CAPM model, we said the return that I want is equals to the risk-free rate plus beta into the market risk premium, right? So this is the return that I want, market risk premium. But based on my estimation of certain factors, especially the risk factor, right? Especially the risk factor, I can come up with slightly different expected returns than you. So because of this, my discount rate might be different from you. And the point is, the lower the discount rate, right? Lower the KE, higher the price that I'm willing to pay. Because what is the price? The price is I am discounting it by the discount rate, right? So the discount rate is in the denominator. Lower the denominator, higher the price is that I'm willing to pay. So if I underestimate the risk of the company, I am willing to pay a high price for that company. And the market price is determined by my estimation of risk. Because the person who's willing to pay the most is the person who perceives the lowest risk. The person who's willing to pay the most for a company is the person who perceives the lowest risk of a company. Because their discount rate is the lowest, and therefore they are willing to pay the highest price for a company. And remember, last week we talked about the bid ask prices and how when you're the best bid price is the highest price that is there in the market, because that is the price that the highest price that somebody is willing to pay to buy the security. So market prices are set by the best bid price, the highest price somebody is willing to buy the security at. Okay? How do they come up with that highest price? If you think of it rationally, it's their perception of risk. So, okay. So this example sets the stage for what we call our present value of growth opportunities, right? So let's work through the example, and then we'll go through it and see how that relates to the present value of growth opportunities, or what we call PVGO. Can you start? It's a very easy example, very simple example, much more simple than what you all did earlier, right? So just try the first part and see. First part is the easiest. And what I have highlighted in red here, I have changed the question a little bit from what you have in your notes. Just adjust your notes to what I have highlighted in red. What's this? Type the part one first. Blue color example. Yeah, you must are correct. I only have one answer, and it's such an easy question. What happened to the others? Okay. Yes, Niraj. So it's very easy, right? You have an expected ROE of 20% and plans to pay out all of its earnings. When it pays out all of its earnings, what do you think happens to the retention ratio? You pay out everything. So payout ratio is 100%. That means your retention ratio is zero. Correct. So B is equal to zero. Right? So that means your growth is ROE into B, right? ROE into B is 20% into zero. So your growth rate is zero. So if your growth rate is 0, this is actually a no growth situation. What is the equation for a no growth model? Remember, you can use the same Gordon growth equation, or you can use the no growth equation. No growth model says the value of the company is equals to dividends divided by R. Or if I use the Gordon growth model, next year's dividends divided by R, right? If I use the Gordon growth model says value of the company is equals to D0 into 1 plus G, or we'll use D1 straight away. Oops, better. D1 divided by R minus G. R minus G, but now G is 0. Therefore, D1 divided by R, which is equals to the no growth model that we did right at the beginning, the no growth model, right? So what is D1? What is the year one dividend? What is the year one dividend?
₹5.
₹5, right? Because it says it generates earnings of ₹5 next year. But if you're paying out all your earnings, then your dividend is also ₹5. Your dividend is equals to your earnings. ₹5 divided by 15%. So the company's value is 33.33. $33.33. Right? So that's very easy. That's all there is to it. But if I just take a minute to show you, now this company has an equity base of 100, right? Meaning it's equity. Company's equity is 100. So, and it has 4 million shares. Oops. So if you look at how this would work, ROE is 20. So this year they're expecting that they'll get a 20% return on their equity. Return on equity. Okay. So what does that mean? Balance. What does that mean? If you had an equity of 100, today, right? Equity in year 0, today of 100. You're expecting that this equity, I'll go to a white screen. No? So if your equity in year 0 is 100, okay, and your ROE is 20, then you're expecting that your earnings, right, will be 20. For every 100 million, you expect that next year you will be earning, not this year, next year, right? Because your ROE is your expected ROE. So based on a base of equity of 100, you will be earning 20 million in year one. And you'll be paying out everything as dividends. So you pay out everything as dividends. So therefore, your net earnings are 0, meaning what goes to retained earnings? 0. What goes to retained earnings is 0. So therefore, at the end of year 1, how much is your equity? It's still 100. Your equity doesn't change because retained earnings don't add to it. You're paying out everything inside the company, you're paying it out. Your retained earnings don't change, right? The next year, expecting that ROE will remain the same, the next year also the company is expected to earn 20 million, pay out that 20 million as dividends, and therefore their equity is going to remain at 100 million, right? This company is not growing. Its dividends are not growing. Its earnings are not growing. Its equity is not growing. Right? This company is not growing. It is a no growth company. Yeah. Any questions here? Based on the fact that they will keep on earning an ROE of 20%. Try the second part. Now we have company B. Again, same equity base. So the two companies are similar. The only difference is company B pays out part of its money as dividends, part of its earnings as dividends. This is your equity, not initial investment. This is the company's equity. So that is retained earnings, reserves, plus stated capital that you have to earn. You essentially, what is your ROE? It's how your equity is being utilized, right? So what you're earning from your equity base. Or your net assets, essentially. So the first part is very easy. I kind of gave away the plot, right? So company B has an expected ROE of 20%. Same. It's on purpose, it's the same. But now here they paid out everything. Here they pay out 40%. Equity base is still 100. Based on the data above, what should be their earnings next year? How much should their earnings per share be? How much should the earnings per share? Sorry, 20 million, correct. So earnings per share is the fact that from their return on equity, right? So what is return? Return is your earnings. Earnings divided by equity. So ROE is 20%. Equity is 100 million. Therefore, your earnings are 20 million, right? 20 million per share. You have 4 million shares. So therefore, earnings per share is 5 million. Not 5 million, sorry, 5 rupees. So your EPS is 5 rupees. So how much is the dividend paid next year? D1. ₹2. D1 is essentially your earnings into how much you're paying out, right? So you're paying out 40%. So 5 into 40%, ₹2. Based on this, how much equity will you have at the end of the year? Yes. So now I had, I go to the white screen. Or not. I had 100 million in equity in year 0. From this equity, I generated 20 million profits. Out of 20 million profits, I paid out dividends of 2 million. Is that correct? Dividends of 2 million. No, not 2 million. Sorry, 8 million. Dividends of 8 million. And I'm remaining 12 million. 12 million is return earnings, right? It adds on to my equity base. So now my equity becomes 112 million. 112 million. Okay. So equity goes from 100 million to 112 million. Same way, what is EPS in year 2 and DPS in year 2 and equity in year 2? Don't use growth, right? What it's saying is do it by basic principles. Don't use ROE to be calculate, right? That's not the intention of this. So sorry about that. That is not the intention. Don't use G. You're supposed to do it from first principles. We're trying to show you how ROE into B comes. So what is the next year's EPS and next year's dividends? You have equity of 100, right? And you earn On this equity, you earn 20%. So earnings of 20. And from that 20, you pay dividends 40%. So 8 rupees of dividends are paid. So to your retained earnings, you carry forward 12 rupees. Right? So therefore, your equity at the end of the year now increases from 100, it increases by 12 rupees to 112. Okay. And now, if you look at the next year, how much is your earnings? Not earnings per share, how much is your earnings next year? You're maintaining the same ROE, right? So at the same ROE, how much are you expecting to earn next year? Okay. Nimasha, can you tell me the uh, full figures? 22.4. Okay, thank you. So from this 112, I'm expecting to earn a 20% return. I want to earn a 20% return. So that means my earnings are going to be 22.4 next year. If I look at earnings per share, it was 5 rupees last year. This year, next year, it's going to be 22.4. Oh, no. Oh, no. So to get a 20% return, your earnings will be 22.4. And out of that, 40% dividends will be paid out. So how much is that? 8.96. And you're left with 13.44 retained earnings, which will add on to your equity, right? So on a per share basis, 22.4 divided by 4 million shares comes to 5.6 apparently. And dividends 8.96 divided by 4 million shares comes to 2.24 apparently. And 13.44 added, my equity comes to 125.44. Right. Now, if you all do your calculations and see for each of these, how much is the growth in EPS? How much is the growth in DPS? How much is the growth in dividends or earnings or equity for that matter? How much is it? 5%. Yes. All of these 2 to 2.24, 5 to 5.6, 8 to 8.96, to 20 to 22.4, and even the growth in equity is 12%. This is how we say, and you can keep on doing this exercise for year 3, year 4, whatever indefinitely, and you will see that always the growth will be 12%. As long as we maintain our target ROE, meaning we achieve our target ROE, our growth will be 12%. So this is why we derive that growth is actually a function of our return on equity and how much money we hold back. Because we give 40%, but we hold back 60. We give 40%, but we hold back 60. Based on that retention and how much my ROE is, my equity goes up by that amount, my earnings go up by that amount, my dividends go up by that amount. My growth rate is always 12%. Okay. Any questions? So based on this growth rate of 12%, how much is my company worth? Last part. How much is my company worth? $66.67 a share. Okay. So what do we do? It's a simple calculation because company will maintain 40% payout policy indefinitely. Indefinitely means there is a constant growth rate. My growth rate will not change with time. Okay. And investors' required rate of return is 15. So I can use the Gordon growth model from year 0 onwards to say that the price today is equals to next year's dividend, which we saw was 2 rupees, divided by R minus G. So 2 divided by 3 comes to 66.67%. Okay. Now, the difference, do you also see this company? This is a constant growth company. Okay. This company, company A, was a no growth company. It was a no growth company. But if you look at the optics, Company A pays out more dividends. It gives you a dividend of 5 rupees. Company B gives you a dividend of 2 rupees. So investors might place value on the dividend. Therefore, this company A might be perceived to be more valuable. But is it really? No, right? Because when we did our calculations, we got that the price of company A is equals to dividends for 5 rupees equals to earnings divided by R, G was 0, R is 15%. So this company is only worth 33.33. Only worth 33.33 rupees, right? Not 66.67%, 66.67 rupees. But do you see the difference? This company, which pays out all its dividends, so might be perceived to be worth more, is actually only worth 33 rupees because it's not retaining anything inside the company for growth, right? Versus the company that is retaining money inside it is actually worth more, although it's only paying a 2 rupee dividend as long as it hits its target ROE of 20%, which is greater than the investor's required rate of return of 15%. It's actually worth much more. And we'll discuss this again tomorrow when we do the next sections. Sorry, there's a question that says, is it 2 rupees or 2.24 rupees? It's D1, right? D1 was 2 rupees, right? 2.24 was D2. So this comes up to the concept of what we call PVGO, or present value of growth opportunities. PVGO, right? Present value of growth opportunities, which essentially says a company's growth opportunities, the present value of a company's growth opportunities, how much growth is captured inside a company's share price can be measured. How much growth is captured inside a company's share price can be measured. Because we know now from the previous example, if there is no growth, my company is worth D1 divided by R. But I can rewrite it because what is D1? It's actually equal to all my earnings. Because when do I get a growth of 0? When I pay out all my earnings, right? So D1 divided by R or E1. So a no growth company's price can be written as, or can be understood to be, next year's earnings divided by R, divided by the discount rate. Okay. Next year's earnings. I hope you understand that for a no growth company, the value of a no growth company is its earnings divided by R. The value of a growing company, assuming constant growth, it doesn't necessarily have to be, but for ease of calculation, assuming constant growth, the value of a growing company that is growing at a constant growth is equals to D1 divided by R minus G. Then what should be the difference between these two figures? If your company is paying you constant dividends and is growing at a constant, is expected to grow at a constant rate, right? That means today's price is worth D1 divided by R minus G. Versus if the same company paid out all its dividends. If it paid out all its dividends, then it would be worth E1 over R. Do you see, if I take the difference between these two, the price of my company, how much is my company actually worth, assuming constant dividend model, minus what is the value of my company if growth was zero, meaning the company was paying out all its dividends and not growing at all. This is what we call how much growth opportunities are embedded in the price of the share. We call it the present value of growth opportunities. The company's price with growth minus the company's price without growth. Any questions? So for the sums, just for the ease of doing the sums here, we will use the constant dividend model when we look at the company with growth, but it doesn't have to be. It doesn't have to be. The company will have some value with growth, right? It doesn't need to be constant growth. But we know what the value of the company is going to be without any growth. So if I take the value of the company, a growing company, whether it's constant growth or any growth, minus the value of a company that's not going to grow, what's embedded inside the share price is the present value of my growth opportunities. And as long as the share price is a fair price for the share, then I can use the current share price to figure out how much growth people have factored in to the share price. Any questions? Okay, try this example. So this is the data on purpose is the same as the previous example, right? So you can quickly do what is the present value of growth opportunities. How much is PVGO? It is very easy. Any questions here? Because you're taking too much time for something this easy. I want to discuss these two parts before we finish for the day. So the faster that you all can answer, the faster we can discuss. Is it 41.33? No, I don't think so. Everything is the same, right? It's not. Yes. Yes, it's correct. 33.34. So this is see here, it's the same set of data, right? RO is 20, payout is 40, dividends were 2 rupees, next year's dividends. See, and plans to pay an annual dividend of 2 rupees next year, which is 40% of its earnings. RO is 20, cost of equity is 50. Same set of data. So the price with growth of the company is 66.67. Nimasha, no. Right? Price with growth is 66.67. D1 divided by R minus G. What is G? For 60% of 2012. So 2 divided by 3.03 comes to 66.67. And what is the value of the no growth company? No growth company. You have to find the value of the no growth company. If this company was not growing, then the value would be its earnings divided by R, not dividends divided by R, earnings divided by R, right? That's the assumption. So if the company was not growing, the value would be earnings divided by R. If that is the case, how much is this? Earnings is, you have to back calculate. If 2 rupees is 40%, then 2 divided by 40, earnings is 5 rupees. Divided by R of 15%, 33 rupees. Okay. So then what is PVGO? PVGO is simply the value of a growing company minus the value of a non-growing company. It's 33.3. Right. 66 minus 33, it's 33. Or if I take PVGO as a percentage of current share price should be 66, right? Because this is a hypothetical value. What if the company was not growing? The actual share price should be 66. So PVGO over current share price is about 50%. So 50% of the value of my share, 50% of the value of my share comes from the growth opportunities that I have incorporated, that I have priced in my valuation. That's what it's showing. 50% of the value of my share or the price that I'm paying comes from the growth opportunities that I have priced in my valuation. If this company didn't grow, it will be worth half the price. But given the growth opportunities that I have incorporated into my valuation, this company is worth 50% more or 100% more actually. Right? Any questions? Okay. Try the next part. Leave the dividends at 2 rupees, right? The only thing that changes is ROE. So your D1 remains at 2 rupees. The only thing that has changed in this example is ROE is now 15%. How much? What is the value of this company? What is the value of this company? And how much growth opportunities are you incorporating into the price? Let's finish it quickly, guys. Correct. 28, correct. $39, correct. Good. So here you see now my company's actual value, everything is the same, right? There is dividends. Dividends are being, there's a payout ratio, there's a target ROE, and dividends are expected to grow constantly. Nimasha, there's a small mistake somewhere. Just check it again. So indefinitely, right? Dividends are expected to grow indefinitely. So I can use the Gordon growth pricing model to come up with the price. Next year's dividends are 2 rupees. R is still 15%. But now G is ROE into B. ROE is 15% into retention ratio of 60%. 15% into 60% is 9%, right? So growth rate is 9%. So 2 divided by 0.03 comes to 33.33. That's my growth company's value. What is my no growth company's value? If there is no growth, it's my earnings, not my dividends, my earnings. Because on a no growth company, I'm assuming everything is paid out as dividends. So it's earnings divided by R. So how much are my earnings? If dividends are 2 rupees and payout ratio is 40%, then earnings are still 5 rupees. Divided by R of 15, 33.33. It doesn't change. What does it imply then? It implies to me that PVGO is 0. Zero, right? This company that is paying out dividends, that is growing continuously at a rate of 9%, is worth only 33 rupees. And 33 rupees is the same as the company not growing. If the company didn't grow also, it will be worth 33 rupees. If the company grew also, it will be worth 33 rupees. There is no premium that investors are giving for growth. For the fact that the company is showing steady performance, increasing its earnings, increasing its dividends by 9% every year, forever. Investors are not paying a premium for that. Okay. So we'll discuss why tomorrow. Any questions? Okay. So we'll start with this tomorrow. We'll discuss why investors are not paying a premium for this. With the rest of the questions, we'll see why the investors don't pay a premium for this type of company. Okay. So we'll stop there.
Thank you, madam.
Thank you very much.
Thank you, ma'am.
Thank you, madam.
Thanks a lot. See you.